Hey everyone, welcome back to Upside Down Data. Today I want to talk about the CPI print that's coming out tomorrow and why it might be prudent to expect volatility following that announcement. If you like the content, remember to subscribe to the channel, give the video a like and follow us on Twitter. A lot of updates, better indicators, and more over there. So if you're not following kind of the broader markets, you might not have seen, but the CPI print, the Consumer Price Index print for last month, September, is coming out tomorrow at 8:30 a.m. EST. And the reason why this matters and why people follow CPI prints recently is that, inflation has been driving the boat. The inflation is driving what the Fed is doing. What the Fed is doing is driving markets, and risk assets have not been doing well as the Fed has increased tightening. And the idea is that the Fed will just go on increasing tightening. They'll see no reason not to slow down their tightening until they see inflation start to ease up. So you'd like to see these inflation prints for risk assets to do well following them come in below expectations. You'd like to see a below expectation CPI print. So we're going to have to see what happens, but there's some reason to expect that this one might come in hot, which we'll talk about in a minute, which could then set us up for some downward volatility. So let's talk a little bit more about why we might especially expect volatility right now in the market. And part of the reason we might expect it is just purely technical. So if we go ahead and just look at the Bitcoin chart, what I put over on top here is the Bollinger Bands indicator. I haven't really talked about this before, but it's an indicator I think is useful for getting an idea of volatility in the market. Basically, the way that the Bollinger Band works is that there's some moving average, and then you're calculating standard deviations up, above, and below that average on kind of a rolling basis. And what you generally notice is that when you get big volatility moves, like big moves in one direction, the width of the Bollinger Band from the top part of the band to the bottom gets wider. And then you get into these periods where you kind of crunch. You kind of narrow down, the volatility gets tighter between the two, the top and bottom gets tighter. And then it kind of squeezes, and then it'll break out again. There'll be some big volatility move to one direction or the other, and then you kind of squeeze in again. And you'll notice right now, look how tight the Bollinger Bands are right now. It's actually, if we're just looking, it's one of the tightest kind of levels that we've seen. And we can visualize this a little bit more clearly. We just pull up this Bollinger Bands width indicator, which is really just documenting kind of how large is the gap between the top and the bottom band. That's what this is doing. So this gives us just a level we can look at. And you can see that right now, this current level is pretty low. It's one of the lowest ratings we've seen in a long time, really ever since more or less back here. Now here was a massive explosive move to the upside that followed this squeeze. And here's a similar squeeze that had another nice move to the upside immediately following it. But if we're thinking about where this one might go, really what these squeezes mean is they're direction agnostic. They don't actually tell you which direction is likely to break. They're just saying that some big move is likely to come soon. The idea is that the market can only sustain kind of this limited volatility for so long before something breaks it out of it and shoots it to one side or the other. So another thing that we can look at for why we might expect a big volatility move here is open interest in the futures and derivatives markets. So open interest is basically just the amount the amount of positions that are open in the derivatives market, either on the short or the long side. And one of the things you'll know if you've been following the markets for a while is that open interest gives fuel to big moves in one direction or the other. The reason is liquidations. If someone is long, if they're betting for the price to go up, then suddenly price cuts against them. What'll happen is they might go down and hit their liquidation price, at which point their position gets closed and all their collateral actually gets taken away and instantly sold. And if their collateral is Bitcoin, which oftentimes is the case, that will then lead to these big cascades in liquidations where, one person's long gets liquidated, all of that gets, that Bitcoin gets flooded back onto the market. That drives price even lower, which then triggers someone else's liquidation price. All of that collateral and everything gets put onto the market, brings price even further down again, so on and so forth. And it can lead to these big kind of massive rips to the downside. The opposite can happen to the upside, right? If people have shorts open, they're betting against the price and price moves against them, then they would get liquidated. They'd have to actually buy Bitcoin in that case to cover their short position. That then drives price up, etc. And it would go the opposite direction. And so you can see right now is on this bottom pane, so the top pane here is the Bitcoin price, bottom pane is open interest. we've seen open interest really get up to a higher point, really kind of the highest it's been in about a month here. After, here we got a big flush out of open interest in this big liquidation wick down here. This is one of those liquidation events where a lot of longs presumably got liquidated, forcing price down really rapidly. We're again seeing open interest being relatively high. So again, if there's some big event like the CPI print that really pushes markets in one direction or the other, people caught on the wrong side of that move will likely start to get liquidated, and that can create a bigger move. And that might just be one of those things that would lead to this expansion of the Bollinger Bands, this explosion of volatility coming out of this squeeze, is people getting caught on the wrong side of the equation on their bets where their open interest is. And so the reason why I think that a downward move might be a little bit more plausible here than upward is that we actually did get a inflation print out just today, just not the CPI. This is actually the PPI, which is the Producer Price Index. And this is basically just measuring inflation at the producer side. It's how much are producers, domestic producers, getting paid for the output that they're putting out. And the idea is that they're getting paid more for their output. That suggests inflation, because those costs are likely to then carry over to the consumers, suggests that the CPI should also be relatively high. Now, the one thing that's different now versus what happened back in September is that it's possible that this is more priced into the market. One of the things that happened, when we got the CPI print, back over here, let's find it. Yeah, back over here in September, which led to this big move back down, was that people weren't expecting inflation to be as high as it came in. People were actually kind of caught off guard, and there were presumably a lot of people who had gone long, who got caught out, etc. The market had to reprice in that bad news. It's possible that this time around it's a little bit more priced in. And one of the things we might look at to suggest that that is the case is the fact that we did just get this sign that inflation is remaining sticky, and we didn't see just a complete dump on Bitcoin here. The market didn't really react very strongly. In fact, technically speaking, although not very much, we're actually slightly up on the day. Whereas, if this wasn't priced in, you'd expect a sell-off here in expectation of even worse CPI. So that would be the one caveat of this being, a horrible bearish event if the CPI print comes in, worse than expected. But it certainly is looking like it's going to come in on the bad side, of saying inflation is sticky, and the surprise to the downside seems unlikely. That being said, though, if there was for some reason a surprise to the downside, and there are cases where the PPI and the CPI will diverge, it's not a thing that will often happen in the long run, but in the short term it can happen. Were that to happen, that could actually be a reason to get a huge explosive move to the upside. And actually, it's possible that that move to the upside would be more violent than a move to the downside, just because it's probably less priced in the market. There'd probably be more reaction. People would be more surprised, be a little bit more, mania possibly entering into the market to shoot it up. And so really all eyes are going to be on that CPI print, right? If it comes in exactly at expectations, maybe not a whole lot has to happen. If it comes in worse than expected, I think a move to the downside from here is very plausible. And then I think retesting some of these lows very much comes into the equation, if not even potentially worse. If it comes in better than expected, though, then we could really come up and start to maybe even try to retest some of these previous levels we've been at before. Now, the final thing I want to leave us on here, just as a note, and another thing to think about in terms of if we go to the downside. So what I'm showing you here is some on-chain data. This is the long-term holder realized price. It's the average cost basis of long-term holders. Talked about this before many times on the channel. But one of the reasons we think it's important to look at is that, long-term holders are probably going to care the most about what's going on in Bitcoin when they're near their cost basis. And so that's where we are right now. We can see that currently price is very close to the cost basis of long-term holders. And one of the reasons I think this is useful to look at is that we know from psychological theory that people are most sensitive to price movements when you're around their cost basis. You're going to feel psychologically the impact of a price fluctuation a lot more heavily. It's going to influence you a lot more near your cost basis than when you're really far away from it. The long-term holders are probably paying a lot of attention to the market right now and saying, on average, because their cost basis is here, should I just get out and make sure I don't lose money? Or am I going to continue to hold, thinking price might go up, or even add to my position, try to defend this cost basis? And what we've seen in the past is that every single time we've gotten into what ends up being the bottom of the bear market, we actually end up going below the long-term holder realized price. And we did it back here, we did it back here. It actually happened back here as well. And one of the ways we can look at that is that in these moments here, there probably are some long-term holders who are adding into the fireworks leading into that final capitulation. A lot of the short-term holders are already out. Long-term holders kind of adding that final fuel before the market finds its bottom. And if we get some more explosive move to the downside, like off of the CPI print, it would not be shocking to think that that might be what could push us into this final leg like this, which, obviously it's hard to know if that would actually be the final leg, but it would be kind of that next step that we'd expect from history that we haven't seen yet. Of course, it doesn't have to happen. Nothing has to happen, but it would be consistent with history to see that play out. And so it's really events like this. And it's not to say that this CPI print is the make or break decider of if that'll happen or not. But certainly if we get a really bad surprise, if inflation really surprises to the bad side, if it surprises to the upside, it's higher than expected, stickier than expected, or rose more than expected, that could be possibly one thing, especially coming off of this really squeezed volatility, that could lead to another leg down like we've seen in the past, that could ultimately trigger that capitulation down to lower levels. And, we talked before recently about how there's a lot of reason to believe that around the 12 to 13K range could be a point where you'd find support then. That's actually the fair value. If you look at the value of Bitcoin relative to the DXY, that's actually roughly where the fair value point is. If you look at prediction models that would be looking at this, or models that are estimating fair value based on the DXY, I made a video about that recently. Go ahead and check that out, where I presented a model that I made that's a fair value model based on the DXY, and that's where it was saying Bitcoin's fair value is down around the 12 to 13K range. There's also on-chain data that suggests that this would look at, and also just technical reasons, it being this resistance zone kind of back here in 2019, then also at this kind of BART pattern that we got over here in August of 2020. So something to keep an eye on. Now, again, I'm not calling definitively that that's going to happen by any stretch of the imagination, right? This is crypto. It could very well be the case that the CPI print comes in, the market shrugs, and literally nothing happens. You never know. But it does just seem that when you've had a volatility squeeze like this, it is often the case you'll get some volatility in one direction or the other. And it would not surprise me if the CPI dictates which way we go. So not financial advice, but something to be watching for as we get that print tomorrow. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. A lot of updates, better indicators, and more over there.